Welcome back. Today I'm talking about the tax impacts of selling an investment property. And what you need to know is that there are two different types of investment properties. You have flip and sells, which are the houses that you purchase to remodel and then sell as quickly as possible. And then you have rental properties, and they are treated very differently for tax purposes. With flip and sells, it's pretty simple. The profit made on those houses is taxed at regular income tax rates. You take the amount that you sold that house for and you subtract everything you put into it, the purchase price and all of the costs of getting it ready for sale, and you have a profit that is taxed at whatever income tax bracket that you happen to be in. Very easy. It's a little bit more complicated for rentals. Rentals are considered a capital asset, so any profit on the sale of those assets is taxed at capital gains rates. It's more complicated to calculate though. So you have what you purchased the house for, and then of course you have what you sold it for, but there's a lot of in between there to include any capital improvements. So what I want to do is I want to take what you purchased the house for and add back in the new roof that you put on there, or the HVAC system that you installed, or the major remodel that you did to get it ready for rental. There are a lot of things that I can add in to increase your basis. So you may have purchased the house for $150,000, but by the time I add those back in, the basis of the house is actually $200,000. So what that does is when you're taking the profit, let's say you sold it for $300,000 and you subtract that $200,000, you now have $100,000 of profit that's going to be capped at capital gains tax, except that there's one more little caveat. When you're renting a property, you're generally taking depreciation on the capital asset, the rental property or any of the remodels or anything that you've done to that house over time. Now, the government says we can get the tax benefit while it's being actively rented, but that we have to give that tax benefit back when we sell the house. And what it does is effectively reduce the basis of your house. So what happens is we now have a house that currently is at $200,000 basis, but now you have $50,000 in depreciation you have to recover. So now the basis of the house is $150,000. So instead of a $100,000 profit, you now have a $150,000 profit that you're going to get hit with capital gains tax. It's very important in both cases, in both types of investment properties, that you are talking to a CPA. One, so that you have an idea of what you're going to be paying in taxes, and two, so that you can pay those taxes ahead of time so there's not a nasty surprise at the end of the year and you don't get hit with underpayment penalties, just to name a few of the things that can happen. So as always, the overall reaching message here is call your CPA or call me. I'm always available to help you. All right, so next week I'm actually going to talk about something that is very, very confusing for a lot of small business owners, and it's meals and entertainment. It's not as simple as it sounds, so that should be a fun video to have, and we'll talk to you soon. Have a great time till then, everybody. Take care.